The main action on the share market today, leading to a fall of 0.2% in the All Ordinaries Index, was that retailers and banks fell because investors seem to have just woken up to the notion that a slowdown is coming. But bonds have been telling them that for 6 weeks. The bond market is known as the source of truth, as opposed to the share market, which is the source of emotion. Bonds are government IOUs and they're bought and sold on yield rather than price. And when yields go down, that means bond investors think an economic downturn is coming. The 10-year government bond yield has fallen from 4.2% on June the 15th to below 3% today, which is a very rapid decline indeed. It's not yet predicting a recession, but definitely a big downturn. And that's starting to show up in discretionary retail sales like eating out and recreation, which have been declining since the first rate hike in May, while essentials like food, transport and power have continued to climb. And remember, that's coming off a very high base. Overall retail sales are currently $6 billion a month higher than February 2020, before the pandemic. And that's split as follows: 1.6 billion extra on food, 1.4 billion on household goods, 805 million on clothes and shoes, 223 million in department stores and 968 million eating out or takeaway. And don't forget, that's a month. The US market fell last night, but Asian markets rose today. Gold, base metals and iron ore all fell, while oil went up on commodity markets. And the Australian dollar fell against the US dollar but rose against all other currencies, and that tells you it was the US dollar rising. And that's finance.